Good afternoon, everyone. Morning for some, evening for others all over the world. Welcome to today's live trade session. Well, you can't say that I didn't say anything about it. So, today, of course, is the first calendar day of the month. Last week, we saw SPY move down, especially at the end of trading on Friday. You put those two things together and you have a very, very high probability. I, I shouldn't say high probability. The statistics of past movement in the history of SPY and stocks in general is that the first calendar day in that scenario is tremendously bullish. And so I mentioned that on Thursday that we have the first calendar day coming up, and sure enough, we're up almost 900 points today. Of course, that starts at the close of the trading on the last day. So if you're not in it by the close of trading on the last day before the first calendar day, then you might not be. You might miss some or all of it. That wasn't the case today. You would have missed some of it, but certainly not all of it as the market has continued to move. So I have been talking about this. When I first started discussing the first calendar day was back in 2007. That's how long. And obviously I'd done research back then, but that's how long this thing has just been reliable over and over and over and over. So the first calendar day of the month, once again, proves itself to be a worthy investment strategy in and of itself. Now, of course, that has nothing to do with what we're doing in the SPY options and whatnot, but it is a bonus that I mention every single time we come up on a first calendar day of the month, just to let you know. And of course, we did discuss some trades to kind of focus on the more bullish side of things on Thursday. Tried to get into one. It wasn't filled on Thursday. By the time Friday came around, it just depended on how aggressive you were on trying to get into trade for this particular scenario. All right, so there, that's enough on the first calendar day. Don't want to spend any time on that. I do want to welcome you to the call. Before we get into the trades today, a couple of announcements. First of all, y'all have been waiting for this, and I know you. I've been talking about it since the beginning of January. Well, we're pretty much ready to roll this out, and come to find out, the laws actually that allow us to do it the way that we're wanting to do it actually don't take into effect until March 15th. So officially, we can't even offer this thing until March 15th. So if you're waiting, that's going to be now the launch date, and I'm pretty sure everything is as far as the legal aspect and I's being dotted and T's being crossed. I think we're pretty much done. I'll talk with the company that is helping us do this probably tomorrow to make sure. So nonetheless, that's going to be the official launch date. Can't do it. Laws won't allow us to do it. Actually, the laws will allow us to do it, but we have to do it under a different. We would have to do it under a different set of laws, and I don't want to do that. So that is the announcement. If you want to buy stock in Trade Partner, that's what we're going to be allowing anyone to do. If you want to buy $100, you can buy $100. If you want to buy 1,000, 100,000, doesn't matter. Anyone can buy stock in Trade Partner. So that's pretty cool that the users can actually be part owner in Trade Partner. So we're really excited about that. Let's get into the trading. First of all, for those that are new on the call, welcome to today's call. I don't explain everything about all of these trades in the call. It's impossible for me to do so. There's just too much information, too many details, too many different strategies that we talk about in order to explain everything on the call. So don't, if this is your first time, don't walk away from this call saying, well, I didn't understand a thing, and so it's not, go on to the next thing. Well, it is really, really important that you spend a couple of 3 months before you decide that this is not for you, if that's what you end up deciding. But I want to tell you right now that it is well worth it. And there are many reasons for that. The biggest one is the same reason that I give in instructions about these trades. And the very first one is start small. So these trades are fantastic, but they are not the holy grail. And you need to start small. And you need to make sure that you understand what you're doing, you understand the risks that are involved, and that you allow your success to increase your trade size. That is the most important principle that you can learn in trading, is to allow your success to increase your trade size. You earn it. You don't get a right to a larger trade size. I know everybody thinks you do, but you don't. You earn it. And so you want to start small. And the great thing about starting small is that you can compound. So we'll get to that here in just a second. Nonetheless, when you put these trades together, you want to make sure that you are not reckless in how you put them together. And you want to make sure that you follow the instructions. You want to be very careful, very intentional about how you do these trades. Now, here's the compounding. Here's why you can start small, and it's really not going to affect you unless you don't make money. Right. So if you start big, let's say you start with 10, you're like, yeah, I've got $100,000 account. I can throw a 10 lot, no big deal, blah, blah, blah. But you don't really understand everything. You make a mistake. It's a $2,000 mistake. You're like, okay, well, maybe I need to pay attention a little more, be a little more careful. Maybe I need to learn more, whatever the case is. If you would have started small, you would have learned whatever it is that you learned on one trade as opposed to 10. And so, um, if you start small and you compound it as you increase, so this is basically when you increase by about $100. When you have net $100 in profit, then you can start to increase. You go from 1 to 2, and then you just follow this compounding plan. It is not a fixed fractional compounding plan. It is a fixed ratio compounding plan. I know there is a difference, but if you can average $100 a week with this compounding plan over the course of 6 months, you're talking about growing your account by $30,000 in 6 months. If you can average just $20 a week, you're going to grow it slower, but you're talking about long-term growth that is absolutely spectacular. So this is the end of the compounding plan, of a 5-year compounding plan. If you can average $100 a week, look at the total there. It's at $3.3 million. That's approximate total of what the compounding will do if you can average $100 a week. But if you can't average $100 a week and you average only $20 a week, you're still talking about a growth rate that exceeds the fastest growing stock over the last 5 to 7 years, which was Netflix. And that may be taken over by a couple of stocks that are kind of nipping on the heels there, but you get the point. You don't have to do a lot. So what is our goal with these calls? It is not to uncover the Holy Grail. It is not to make these massive, huge, profitable trades. It is to be consistent and put ourselves in a high probability to make 20, 30, 40, $50 a week. And that's it. And if we can improve and get to the point where we're averaging 100, even better. But that's all you need to do, because it's the compounding that is going to build the wealth. All right. Now, having said that, let's take a look at a couple of trades before we get into the focus of today's call, which is going to be on crazy calendars. That's what we're going to focus on today. I told you guys I was going to try on Mondays. I'm going to try and focus on one of the strategies. So every Monday I'll focus on a different strategy, as opposed to trying and going through 3 or 4 strategies. But at the same time, we're in other trades than the strategy that we're going to focus on, right? So I do need to cover those. The first one is option insanity. It's the one that has the greatest amount of margin. It's also the one that provides what I call cross compounding. It's a very high probability approach that doesn't compound very efficiently. So you can't compound according to the table I just showed you with this strategy, but it can be used in what's called cross compounding, so that the profits from one strategy can actually go to help compound another strategy. Very, very powerful approach and principle. All right, so this is the option insanity. Option insanity is for low volatility market in SPY, which is usually going to happen when stocks are near or at all-time highs. That's when this is the best, and that is, of course, where we've been for quite some time now over the last 3-4 months. As we recovered in the broad market from the pandemic, these option insanity trades have been available, and we've done really well with them. And so this one is one that was recently replaced from the last profitable trade. This is a 5-1 where we sell the Monday, March 22nd, and we buy an expiration that is before this. Now, you can do it several ways. You can buy the March 15th, you can buy the March 17th, you can buy the March, I think it's the 18th. I chose to buy the March 15th because it was cheaper, created bigger credit. And then what I did is I ended up adding a second long, and which is not necessarily something that I do often, but because of the situation with the market moving down last week, and knowing that today was going to be bullish, and the first week of March generally is bullish, most of it occurring on the first calendar day, but the rest of this week is pretty much bullish. I don't think we're going to see what we saw today the rest of the week, but we'll probably end up, based on history, we'll probably end up higher than where we are right now at the end of the week. So that kind of puts us in a really good spot with this trade. But what I did is when the market was down, I actually added an extra long to help boost this thing a little bit. Whoops. And so by adding that extra long, my credit actually went to 218. So I don't make quite as much if the market moves down, but look, my profit bubble expands to where break even is all the way at the 407 is where this market can go. And of course, this week and next week will be the weeks where this really starts to become profitable. And as of right now, my average in the longs, I believe, is at like 280. And as of right now, we're making a little bit of money on the longs, and the shorts are at about $1.20 right now. So we're making money overall, and we're not even into the bubble, right? So we're trading at below 390. As we get closer and into this bubble, we should start to see the profit potential increase, especially since I got into those two longs as opposed to just one long. Okay, so that's that. I mentioned a trade that we got into last week. This is the risk-free calendar approach that we got into, where I basically started with the risk-free calendar core trade, added a couple of risk-free calendars, and then took off part of the core trade and created literally a significant risk-free scenario. Of course, the market tanked. All I did was make the credit on this. Then we have a similar one that we had placed on, and of course, again, the market tanked. This is 397, 401, 402 is the core trade. That was filled at 108. It was the next day that we ended up creating one of the risk-free calendars at 93 cents. We bought another long, so we've been looking to sell a 401. Of course, that isn't even anywhere close to happening right now. This trade ends this week. We have a small credit. We might come out of it, maybe if we move up a little bit, we might have $35, $40, $50 potential on the trade. If we do go to 400, then there's a little bit more potential on this thing. I don't think we'll go to 400 by the end of the week, but who knows? Okay. And then one last thing, the uh, uh, core trade of the risk-free calendar is not necessarily a bad trade to put on all by itself. This is one that I was showing a couple of weeks ago when the market was trading in the upper 380s, and then you go 397, 402, 401. That's the strikes on this thing, and you could have brought in 55-cent credit, and you could just held on to that and been done. And that's a 55. That was a $55 profit. So that had a pretty high probability of making the credit on this particular trade. And sometimes it can be that simple as just put on a trade that has a high probability credit, and that's it. You don't have to be too complex with this stuff in order to average $20, $30, $40, $50 a week. All right. Right now, none of these were crazy calendars. We did talk about a crazy calendar on Thursday, and that is what we are going to focus on the rest of the hour on today is crazy calendars. Now, I will tell you this, that crazy calendars right now are not as good as they were when we first started looking at the crazy calendars, when they started becoming available, which was, I want to say, back in late September, early October. And there's only been a couple of times where we've been kind of caught on the wrong crazy calendar. But both of those times, the market moved back into the profit zone. Part of the problem right now with crazy calendars is that the volatility in these options continues to sink. As we continue to move up, and as you well know, if you've been a part of this call for any period of time whatsoever, you know that as the stock index markets move up, volatility comes out of the calls. Today is a big volatile day in SPY, up 900 points. That's a big volatile day. The call options don't reflect that volatility. Doesn't matter. When the market moves up, I don't care if the volatility is higher. If the market moves up, volatility comes out of the options. And that's just the way it is. It's been that way for, obviously since when we're talking specifically about weekly options, but even more specifically, and the spreads that we generally focus on is Friday, Monday spreads. And so the longs with crazy calendars are in Monday, and volatility decreases in those options as the market moves up. So, one of the things that the crazy calendar is all about is we're trying to buy cheap calendar spreads. We don't want to trade calendar spreads alone because the probabilities of success on just a calendar spread without anything else, not very good at all, as a matter of fact. And in fact, right now, because of where volatility is, it's actually negative overall. So negative probability, not by much, but it is a negative probability. However, when you use these in a different way, you have a different purpose behind them, then you have a whole new set of probabilities. And so what we do is we're trying to buy a bunch of cheap calendar spreads and then find a way to pay for them because we're going out of the money. And if we can pay for them, then that eliminates the risk to the downside, which exists in calendar spreads. It's very small, but it nonetheless does exist. So that's the main focus of what we're trying to do. And there are many ways to pay for them. And I'm also going to tell you that the key here is that you buy cheap calendar spreads, especially now that the volatility is just tanking out of these options week after week as the market continues to edge higher. It is really important to get these at a cheap price. and it is becoming harder to do that and stay and pay for them, but they do exist. They still exist. And we're going to talk about a few ways to pay for them. We're actually going to do a deep dive into these calendars and just kind of take a look at some different expirations and different strikes and see how they work. This is one that we were looking to get into on Thursday. This is 312, 315, and this is a 312, 315 diagonal spread, 397, 402. That's the diagonal spread. The calendars are the 400 calendars, and the diagonal spread is being used to pay for those. And of course, if we can get the whole thing for a credit, and we were looking at a possible credit of 5 cents. So there's no risk to the downside whatsoever. And as the market moves into the profit zone, then we are looking to take a profit. We're not looking to grab $400 in profit. That's not going to happen, number one, because it only happens at the peak of this option. All right, the peak of the calendars. And so if you're either on the left side or the right side, then that profit potential drops off pretty quickly, especially if you start going off to the right side is what this shows. But it's actually not as bad as what this shows because the calendars actually do hold their value more if they're in the money than if they're out of the money. So this one actually comes out a little bit more as far as the break even is concerned. But this one, this was a 2-week trade, so it doesn't expire this week. It expires the following week. And of course, we're trading now at 389, and so we've got 2 weeks to go up to 400. I think that's very, very realistic. I think we're really close from that. So, yeah, you can't put this on exactly the way it is right now. It's showing a bid ask of credit of 3, debit of 12, and a mid at 04. I'm not going to put this on at a debit. As a general rule, I put everything on at a credit. Now, what I can do is I can start looking for others and see if I can't put something else together and create a high probability trade on this. Again, we're not looking to pull out $400. We're not looking to even pull out $200 with this thing. We'll play it by ear. If especially the Thursday before the thing expires, that's usually when we're going to get out of these things, is on Thursday, unless there's no reason to get out because all there is potential profit. If the market makes a move up, if the market doesn't move up and moves down, we're not going to lose anything else. We've got no risk. So we do play these by ear as far as the exit is concerned. We're looking to exit on Thursday. Rarely will I hold on to one of these until Friday, specifically because of the volatility that drops out of the Monday options. And so it really depends on where it's at. But let's start taking a look at these because it starts with the calendars. And again, we want cheap calendars, right? That's the goal. Sometimes you can put these trades on, and the calendars aren't so cheap, and probably should pass if you can't get cheap calendars. That means that you're getting a big credit for the diagonal spread, or whatever spread that you're using to pay for them, and it probably means it's too close to the money or too close to expiration. One of the two. All right, so let's take a look at this. This is 3.5. You know what I'm going to do? I'm going to increase the size of that just a little bit to help, maybe help you guys out just a bit. All right, so here is the 3.538 calendar spreads. Expires this Friday, Monday. Obviously, get out on Friday. And the 388, right now we're trading, let me get you an updated price. Right now we're trading, looks like above 390 now. Nope, 389.57. So we're up 920 920 is what we're up, but nonetheless, that would put this in the money by about 1.5 points, and it's trading at 46. Let's go to 389, 47 cents. 390s are going for about 46. 391s are going for about 45. 392s are going for about 43. So you can see there's not a huge amount of price difference on these right now. And you can go out to 395. I actually have a bunch of 395s in a different trade, but those are going for about 32 cents right now. And then they start to drop off a little bit. 296s are at 28, 297s at 23, and then 398s are at 17. So those are pretty cheap. That's a little more than 8 points out of the money. Of course, if it starts to move up to 398, we're going to see an increase in that price. And the question is, can we put this type of trade on this week and pay for it? And of course, what we're wanting to do is we're wanting about generally 4 of these. If I'm bullish, I'm going to go more heavy on the calendars and less credit. If I'm bearish, then I'm still going to put on a crazy calendar trade, but I'm going to put on one that has a higher credit, which usually means I go with fewer calendar spreads. So this one is technically available if you think the market's going to continue moving up to 398 or close to 398, 395, 396, 397. Now, that might be a pretty good one. The question is, can we pay for them with this amount of time left? And that's where you run into a problem with regard to the calendars and trying to do them on a weekly basis. You generally have to go out a little bit further to be able to pay for them. So here is the diagonal spread, and this is a 388, 392. And basically, again, short 3.5, long 3.8. That's the diagonal. 4-point strike difference. This one's going for about $1.90 credit. It's almost $2 credit. That means that the maximum risk on this trade to the upside is only $200. Right? And if the market moves down, we're going to make $200. Now, it has to move pretty far up for this to actually lose the $200. Probably looking at about 7 or 8 point move to the upside. Now you're going to come close, right? So if the market stays exactly where it's at right now, you're probably going to be fine with this trade. If you didn't do anything else with it, this is diagonal. It is bearish neutral, not very big neutral, but nonetheless, that kind of gives you a base point because this is at the money. And of course, in order to increase probability of success, we want to go out of the money. And nonetheless, we're going to take a look at this just real quick, just to put these together. 388, 392, what we want is we want calendars that are basically in between those. You can put calendars at the end of it. So you can do like 392 calendars if you want. You can even do 393 calendars if you want, but you're going to have a pretty high number of calendars because the further away you get from this short, the more of a dead zone that you're going to create. Now we'll go over a risk graph here in a minute so you can see what the dead zone is. You want to keep the calendars fairly close to the short. That's the bottom line, especially in market conditions like we're seeing today, where the volatility is just coming out of these calls pretty fast as the market moves up. All right, so here we have 189 with a 388, 392. What is the 390 calendar? What are the 390 calendars going for? 46. Okay, how many of those can you buy with a credit of, let's say, $1.90? So you simply divide that by 4, and you can see that that would be an even Steven, right? Basically 4. You could buy 4 calendars at 46 cents a piece in a credit of 189. Okay, and that's going to get you something that is fairly close to this right here. It's gonna be fairly close to this, even though we are doing 390s and paying 46 cents, we have the credit on the diagonal spread that pays for those, right? So basically we have a 5-cent credit, only this peak here is not at 400, it's at 390. That's where this peak would be. So you move this whole thing down to 390. And so guess what happens if we start moving up? If we start moving up 392, 393, 394, we're losing money on this thing. And so that's not a very high probability trade. And you'll notice that it's the same price almost as one for the following week that is way out of the money, right? So, so as it's moving right now, the way that the options are structured, as it's moving into the profit zone, there's really not much of a profit available. And again, that's one of the issues that exists with the calendars, the crazy calendars right now, is that we are having to wait for the profit on the trade until towards the end of the week. And if it pops past this profit zone too soon, we'll never be able to get out at a profit. We'll never see this thing at a profit. So we are putting these out of the money in order to try and get this to where, if the market's moving up, it's going to be moving up towards the end of the trade into the profit zone. And that's going to increase our probability of success. Of course, if we have a small credit and the market moves down, we get to keep our credit, whatever that is. All right, so that shows you what's available this week, which is basically nothing is available this week. I want to show you this. We'll go out of the money. Let's go to a dollar credit on the diagonal. So this is 393, 397s. I already know where my calendar needs to be, basically at 395. The question is, can I buy 395 calendars, 4 of them, for less than a total of $1? Right? That's the question that I'm asking myself. And so I'll go to 395, and they're trading at 32 cents. So in this scenario, I'm going to be actually creating a debit of about 25 to 30 cents on the trade if I were to do that crazy calendar the way it is right now. So on that particular trade, that one's trading at a debit, right? So, and it's out of the money. If we do 393 and do the 395s, right? Then on this particular trade, we basically move the profit peak to 395. If we got in at a zero credit, it's trading right now at about a 25 to 30 cent debit. So we would actually have a profit on that trade, and we are still 5 points, a little more than 5 points below the 5 points below the peak. And so we actually might be able to get out of that trade at a little bit more of a profit if the market moves up a little bit higher, let's say tomorrow or Wednesday. Again, this trade will offer an opportunity to get out at a profit. And that's all we're doing. We're looking to get out at a profit. And we are above 390. We're at 390.40 right now, 390.40. So that's so we're actually above into 390 area. All right. Okay, so everybody understands hopefully that aspect. We can't go out of the money with these right now or this week because you can't get them at a credit. You're getting them at a debit. You're paying a lot of money for these calendars. And so what we're going to do is we're going to go a week further away, and we'll start looking at those. And then I'm going to combine these. I wanted to actually, you know what? We're going to combine them now. I wanted to show you logic with regard to putting them together and knowing what strikes you can knowing what strikes you could do and use and what to look for as far as prices are concerned. All right, so here are the calendars, and I'm going to add the credit spread to this. Actually, what I'm going to do first, I'm going to change the date. So this is 3/12, 3/15. So now those are the calendars, and actually I got to select the right ones, 3/12 and 3/15, and so we're going to go 386. Yeah, we'll do this one, 387 and 391. All right, so here is one where the actually, you know what I need to do? I need to do 386, and we'll do 390. All right, 4. All right, so this is one where we're actually past the profit peak. And how do I know that? Because the calendars are at 388, and that's where the profit peak is. And we're trading at 390.50 right now. So we're 2.5 points past the profit peak. And you can get this thing on, you can put this thing on for 92-cent credit. And guess what? That would be a very bearish to bearish neutral trade. If the market moved down a little bit from where it is and stayed here through next week, you're going to make this credit, and you're going to make the profit on the calendars. But the probability of this particular trade being successful is maybe 50-50. And so once you're past the profit peak, it's a different story. And so this one's already past the profit peak. So what we're going to do is we're going to generate the spreads. And since we've combined the diagonal with the calendars, so we get one price. So what we're looking for is we're looking for a credit that is out of the money. Total price should be a credit, and that's out of the money. And so the closest we can go is a 395 calendars for 312, 315. That's not very far out of the money. That is a product of the current option conditions that we are experiencing, is not being able to put this on very far out of the money, going just under 2 weeks out. And this one is not good enough for me. 395 calendars when we're trading at 390 and a half. That's where the profit peak is. We're going to start to lose money after about 397, and we've got 2 weeks to get there. I'm not a huge fan of this particular trade. And you'll notice that you go a little bit further out and you're talking about debits, right? And so that's one of the great things about this, is that you can still put together one of these trades at a credit of 5 cents. And as it gets closer, even if the market doesn't come anywhere close to the profit zone, you can still make $20, $25, $30 out of this trade, right? So here's one. This is 400. These are 400 calendars. It's already trading at this is way out of the money. It's trading at a debit of 28 cents. Right. So if I was able to put this trade on last week, let's say at a credit of 5 cents, and I've already got $28 profit. Very high probability. The market has to go to 400 to reach the profit peak. And so I don't mind that at all, but you have to get the credit first, right? So since I already know that I can't go far enough out of the money with this one to be satisfied with that, then I'm going to go with 319, 322. Whoops. Yep, 319, 322. And let's see here. There we go. And then I'm going to reset the spreads and all right. So now this one, I'm going to make a comment here and I'll touch on it here more in a second. But this is a 386, 390 diagonal. If you can't get a credit on some of these trades, there are ways to get the credit, but you have to take a little bit more risk to do that. Or maybe not so much more risk, but maybe just a slight higher probability of realizing the risk. So this is one that when you're talking about a $1.77 credit total for this, all the calendars and the credit spread or the diagonal spread, you're talking about a maximum risk on this trade of basically the diagonal minus the credit. So this is a $1.77. So your maximum risk on this is $223. No matter what. The problem is that we're already past the profit peak, right? So the risk on this is not tremendously high, but you're looking and if it moves back into 388 area, you're talking about a much bigger profit than a $1.77. But the probability is about 50-50. So net probabilities are still in your favor because you'll have an average gain that is generally going to be bigger than your average loss, because your average gain, if the market absolutely tanks, your gain is going to be $177, right? If the market absolutely skyrockets, then your loss is going to be 223-ish, right? But if the market moves down into the profit zone, you're talking about, if you've got a $1.77 credit on this thing, you're talking about a profit of anywhere from $300 to $500 in an area, and that's pretty conservative if you're right at the 388 area, right? So you will do that from time to time, and that creates a higher average win-loss ratio with a trade that's about 50-50. So probabilities are still in your favor on this one. You're just not going to win as often. So you should still be able to average. When you get in a credit of that size, you should still be able to average a higher 25, 30, 50, $50 over a lot of trades. Okay. I don't do it that way though. I go for a higher probability. All right, so here's 388. Here's the 389 calendars. We're starting to push 391 right now in the market. Here's 390 calendars, and here's 391 calendars. So we're at the profit peak, and it's trading at about $1.60. Actually, it's just slightly out of the money. In this one, it's trading at about $1.60 credit. It has a higher than a 50-cent probability of success, but not much higher. Because the market doesn't have to move up very high at all for this trade to start losing money at expiration. Probably around 394, 395 is going to be the break-even level of this, and that's simply because we have a big credit on it. So you can push that break-even level out a little bit. So it is higher than a 50% probability, and the average win-loss is still going to be better than 1-to-1, because on this one, you have to go even further out in order to realize the maximum risk on this trade. So you're probably looking at like 400, and you're starting to push. You might be starting to push the $200 risk on this. Okay, so I'm just telling you how these work, regardless of where they're at. And so let's see how far we can go and still bring in a credit. I don't know that is 396, 319, 400, 398. That seems like a pretty high credit. It almost seems like that seems like too high of a credit. That's a $1.35. Maybe not. Oh, you know what? I know why. Guess what, guys? This is a unique week. I almost let that one slip. This is a unique week. 319, 322. What is unique about the 319, 322 spreads? And why are we seeing calendars that are like 15, 16, 17 cents out there? The reason is because this is, I almost forgot, this is ex-dividend month. And this is the third Friday, and that's when the ex-dividend happens. So these options are actually priced a little bit differently because of ex-dividend. Now, it doesn't really affect us a whole lot, but the calendars aren't quite the same. They're actually more like a 1-point diagonal spread is how they'll be priced. I forgot that this was that month, and that does add a slight level of complexity to the situation. That it doesn't keep me from getting in trades because I'm usually going to be out on Thursday anyway, and you would want to be out on Thursday before expiration if anything is in the money. If it's not in the money, you don't have to do a thing. You don't have to worry about anything. You don't have to, only if it's in the money. And so if we go far out of the money, and we put ourselves at a high probability, look at this, we can get 36 cents for 402 calendars. And as long as we are at or below 400 on Thursday before this Friday, we're not going to worry about being assigned. The thing, though, is that these calendars aren't going to be worth as much because it's going to be priced as if it's a diagonal of about a 1-point diagonal. So at this point, we're looking at the credit, and we can go out way out and create a credit here. So now the question is, do I want to go into that area right now with these? You know what? No better time to learn than now. I'm actually going to put this trade on at a 30-cent credit, knowing that at 403, my profit peak is not going to be as big as a normal profit peak is going to be, because this 322, 403 is going to be priced more like a 404 by the time we get there. Why is that? Well, I'll tell you why that is. Because on ex-dividend, what they do is they, if you're long, you get paid the dividend, and then they adjust the price. And they adjust it by the amount of the dividend. Of course, that can be immediate as soon as trading starts. But they do nonetheless deduct the dividend from the price. And you'll see the price from Thursday's close to Friday's open. You'll see it drop by a point if no trading affects the market at all. I say a point. It's whatever the dividend is. It's going to be around a point. Okay. So that means that they're going to price these options more like that, expecting that 1-point drop. 1 point ish. I don't know what the dividend payout is going to be this year or this quarter, but it's going to be 1 point ish. It might be a little more, might be a little less, probably a little more at this point. So I'm going to put this on. Obviously, you need to decide whether you want to be tried by the fire on this one and watch it play out. Of course, the risk does not change on these. All right. So if we pull in a credit of 30, the risk is not going to change on this. So you don't have to worry about that. What you have to worry about is being out on Thursday if this goes into the money at all. And of course, we've got not quite 3 weeks on here. So 2 weeks and 10, about 14, 13 trading days. as of we're at the close on Monday, so we're 13 trading days is what we're looking at here for the market to potentially go up and be above 401-ish. It's not exactly if 401 is in the money, probably don't have to get out. It's a little bit different than that. It has to do with how much extrinsic value is on these things. If there's enough extrinsic value, they're not going to assign you. And so, at any case, I'm going to go ahead and put this trade on, and I'm going to put it on at a credit of 30. And I say I'm going to put it on, but one other caveat that they've kind of messed with us since we started this is they've always kind of had this as a rule, but it hasn't necessarily been enforced until recently. I've noticed it's been enforced, and that is they only allow 3 lots on a multi-leg spread like that. So I can't go 4 calendars, I have to go 3. So what I'm going to do is I'm going to put this trade together, and then I will discuss a little bit about how do you average $20, $30, $40, $50 a week when you have to go 3 weeks out to put on a trade, or almost 3 weeks out, not quite. And so I'll talk about that here in a second. I'm going to put this together. Yeah, I'll go ahead and put it together right here. Let's see here. So I'm going to go. I'll change the strikes. And then let's see, sell and buy. All right, so I just threw some options in there and I'll create it the way it is. All right, so we're looking at 401 for the first one. And then a diagonal will be 405. And then the calendars would be 403. And oops, there we go. And of course, we're going to do 4 of them. And it's trading, that spread is pretty big. It's trading somewhere close to around there. So I'm going to go limit of credit of 30. And I want to see if they'll take it. Sometimes they do, sometimes they don't. So we'll see if they take it. If they don't, if they reject it, then what I'll do is I'll do 3 calendars with that one trade, and then add the 4th calendar as a separate trade. Okay. All right. So kind of a weird week to start the crazy calendars. I totally spaced it until I saw the pricing. And I'm like, wait a minute, we shouldn't be able to go that far out and still get a credit. So that's one of the benefits, though, when you follow these. And that's why I say, if you're getting into this approach, if you're going to trade, you want to become really, really familiar with one strategy, maybe 2. If you really have a good understanding of everything, you can do it with 3, but you really want to become good with 1. You want to know exactly how the spread works. You want to know exactly how the spread reacts to price movements. You want to know exactly how the spread reacts to volatility. And I can explain all of this, and I do. But for you to really understand it, you have to watch it, and it's a matter of exposure, right? And so if you become really good, and you watch these, and you become saturated with them, and you understand them inside and out, then you'll know when something is not right. Price is wrong. Something is off. Blah blah blah, and that's what triggered my oh yeah, it's ex-dividend month, is the fact that I knew that we should not be able to go that far out and still get that kind of credit. on this trade. So far they haven't rejected my trade, and it looks like it's working. It's not filled yet. We're at a credit of 28 cents, and it's placed at a credit of 30. Now, if I want to create a bigger credit in a situation, what do I do? Or if I can't get a credit, all right, let's go back to 312, 315, and kind of take the ex-dividend out of the picture for just a minute, if you will. All right, so this is again the 388 calendars. Then we have a 386, 390 diagonal spread, right? And this one is trading at a credit of 48 cents. It's not very high at all, but it is past the profit peak. And right now we're at 390.77, right? So we're almost 3 points past this profit peak. All right, we already knew we couldn't go very far out and get a credit. So what can I do to increase the credit? There's two things that I can do. Number one, I can, instead of a 4-point strike difference, I can go 5-point strike difference. And so we went from 46-cent credit to a $1.15 credit by doing that, and that may alter. So I'll go ahead and generate that one now and see how far we can go out of the money and create a credit with 312, 315 with a 5-point spread. Now, the one thing that you need to understand is when you create the 5-point spread, you're increasing your risk by $100. But you're also increasing your ability to take a trade with a much bigger credit. So here's 393, 395s. And that one was, you couldn't even, you could create like maybe a 5-cent credit with the 397 calls. Okay, so the profit peak at 395 on that one, less than 2 weeks to go. Not awful. Now I can go all the way, create a credit, maybe of 3 cents, and have 398 as my calendars. But again, my risk on this trade now is at 500. If the market absolutely skyrockets between now and next Thursday, my maximum risk is at 500, and it's going to take it to, it would have to go to like 405-ish in order for me to actually realize that kind of loss. But that's what you're looking at. Okay, I can further. So the farthest we can go, excuse me, and create a credit is with a profit peak of 398. That's actually not bad. I wouldn't necessarily not do that, except for the fact that I think they're going to push it to 400. I think they're gunning for 400, and at that point, you're going to see me be pretty aggressive on putting some of these trades together. So stay tuned if that in fact does materialize. All right, so one other thing that you can do to increase the credit, and that is to not do a diagonal spread to pay for it. You do a credit spread to pay for the calendars. Okay, and now we've gone from a $1.15 to a $1.58 credit. Now, if you have a $1.58 credit, what's your maximum risk on this trade? It's $342. Right, 5 strike difference between the credit spread. All your calendars are already priced in here, so your risk is $342 on this trade, worst case scenario. However, we're already past the profit peak on this one, right? So trading at 390.66 right now, that's almost 3 points past this. We would be very close to the break even where it is right now. However, if we move back into the 388 area by next Thursday, we're talking about pretty significant profit potential. So again, because of the bigger credit, it still has a positive probability, but you're not going to win as many times. So let's see how far out now we can go and still create a credit. Looks like, oops, I didn't reset. Sorry, guys. And so 312, 312, yep. So I'll go ahead and do that. And we'll let it filter in all of the prices. Da-da-da-da-da-da. There we go. And we're just going to scroll until we don't see a credit anymore, which is right here. 401s are the profit peak. So I have just basically created as far out of the money as I can possibly go and keep a reasonable risk on this, and creating a profit peak at 401. And so if they start pushing it to 400, this is going to be a profit on next Thursday, and we would look to exit if you can get this for a credit. It's a bid ask of 7. It's a pretty wide bid ask, so you'd probably have to work it a little bit. But I wouldn't necessarily not mind doing a 398, 403, and 400. Bear in mind, with a credit spread, instead of a diagonal, the risk actually drops off really fast after this credit, or after the calendar spread. So 401, 402, you're going to start looking at a loss, especially on the very last day if you don't get out early. On Friday, you're going to be looking at a loss on there fairly quickly. So that is the one thing, is that we've basically got a hard point at which that can be profitable. However, the one thing that I like about that is if the market starts to move up to 400, I am going to place on another trade, and I'm probably going to be able to place on another trade that will have a very high probability of offsetting some of the risk on that if the market moves up. So I may add to it. All right, so last thing I want to cover. So hopefully that, again, going through each of the steps, the thought process, less risk, the higher credit, trade-offs on each, how far you want to go out of the money. I mean, we've covered a lot. Last thing I want to just briefly mention is how do you pull in weekly income? If we have to go, well, in this one, we can literally go 2 weeks out. We don't, or less than 2 weeks out. So you don't necessarily have to go 3 weeks out, but you're not going to pull in a whole lot unless the market begins to move up, right? So how do you do this? Well, sometimes it means you have to have on more than one trade at a time. So I'll have this trade on for next week. So let's say I decided to put this trade on at a 5-cent credit. I have this trade on for next week, and then next week, depending on where the market is, I'll put on another trade for the following week. So they may overlap. And that way I've got a trade that I'm getting out of at least once a week. And if I go out 3 weeks, then that means that, I'm going to have to, if I want to do this on a weekly basis, then I'm going to have to do it where I may have 3 trades that overlap. And the only issue there is that if all 3 trades are based on getting in at the same time, not the same time with regard to time-wise, but price-wise. So if the market stays the same, next week I may put on another 400 for the following week, right? And then this one hasn't gone anywhere. But that's not necessarily a bad thing, because that just means that if this one, the probability is I'm going to make money on this one, even though I have a little bit higher probability of maybe not making money on the next one if it moves up too far. But this one, it would look pretty good. So in other words, next Monday on this trade right here, if we're still trading at 390, there's almost, not quite, but almost no risk of this having a significant loss by the time you get to the end of the week. Because by that time, as the market, if we're trading at 390, it's only got 4 days left to travel up to 400, and technically really 3 because we're not generally going to hold on to it until the last day. So we'll exit it on Thursday. So it'll have 3 days to move up to 400, and at that point, the 400s will be um, uh, obviously at the profit peak is the 400, and so we should be able to see a profit come um, out of that trade. Okay. All right. So let me see here on the. Up, they're still allowing me to work that trade. It's trading at a mid of 30 cents right now, and I'm not yet filled on the trade that I tried to place here a second ago. All right, so there is the calendar spreads, crazy calendars. Let's go ahead and take questions. All right, what if March 1st is on a Saturday or Sunday? Is the first trading day still bullish? Great question, Harry. And the short answer is not as much. So you have 2 aspects of it. You have a first calendar day, and then you have a first trading day. And when the first trading day is not also on the first calendar day, it is still bullish, but not quite as bullish. All right, I'm not, let's see, I'm not understanding why we're taking so much time talking about. Mark, I'm trying to teach the process of going through this. Trying to teach the thought process. Let's see. Will trade partner be available in Schwab? We do not. We're not working on Schwab right now. So Philip, maybe you can tell me. I don't have an account with Schwab. Maybe you can tell me what are the costs of an option trade in Schwab? Are they commission free, and what are the fees that they charge? So like TD Ameritrade. TD Ameritrade charges 60 cents an option. They say no commission, but that's a commission because the actual clearing fees are less than that. Edwin, dividend week. Yep, thank you. You saw it probably before I saw it. I just completely spaced it. All right. Would you ever consider trading XSP instead of SPY? So the problem, you mean SPX, not XSP. You mean XPS. Yeah, there are some issues with SPX. Obviously, it's much bigger. It's a tenfold contract size, which means that your starting small is actually starting like a 10 lot in SPY. So so the short answer to that is no. Long answer to that is once if you grow your trade size, you can then start looking at switching to SPX and doing a 1 lot in SPX, but you would have to go from 1 to 2, which is equivalent of going from 10 lot to 20 lot. So again, I don't know if you want to do that. You may want to hold off a little longer before looking at switching if that's what you're looking to do. I had a custom spread on last week, had an exit limit of 0.5. The spread hit the limit and even below for a few minutes, but never filled. This is one of the legs, maybe it was 0.0. So if one of the legs are at 0 or 0.01, just don't exit it. Don't put it in the exit, because yes, it will. It can and will affect that. But moreover, the more complex the spread, the less likely you're going to see. I mean, you're going to have to see it trade at that. You're going to see, as a general rule, a higher bid-ask spread. And anytime you have a higher bid-ask spread, it's going to have to trade closer to the bid before it gets filled. So in those custom scenarios, you might want to look at legging in and legging out. Let's see, even with a big move down last week, 3-1 option, Sandy pricing didn't change much relative to the price drop. Do you attribute that to the speed or the move? It's volatility affecting the pricing, Dan. I actually put on another option in Sandy trade, but you got to understand that what you can do, so if you're in one already and the market does move down with an option Sandy trade, is you can either hedge it or maybe add to a long, and then push that break even out, which is break even level out, which is what I did to last week because of the move down. And it depends on how far out you are. So last week I had a profit of about $250 on the option insanity trade. All right. So, and yeah, I'm going to try and get into. I have a feeling they may not be filling me on this 4411 because it's a 4411. So I'm going to change that to a 3311, then add. Actually, I'm not going to change it. I'm going to add another one to that. But back up to this. So by adding the long, I had a $250 open position profit on a $450 credit, and I used some of that to just buy the long and create this just monster profit profit zone here, because the chances are that I'm going to be able to further hedge this and then add to it. Right, so I'll profit stack my option insanity trade. Is first day of every month generally bullish or applies only to some months? Mike, great question. So August and February are the least bullish, but other than that, it's pretty much March is a great one. October is a great one. December is the best one as far as probability is concerned. And when you talk, if the market is down the day before, it's even better. If the first calendar day occurs on a Wednesday, that's the best. Wednesday, first calendar days have the best statistics. So, Philip James, 65 cents. It's adding to a hedge if the market moves up. What would that be? Adding a trade to hedge. I think you're talking about the option insanity, Paul. So by adding the same long, so I now have 5 shorts and actually 2 longs. And that acts kind of like a hedge, not quite, but I now am technically only naked 3 calls. And at that point, let's see what they're trading for right now. Let's see, and that's March 22nd. If I wanted to truly hedge this, I would have to buy a March 22nd, right? Because well, not that's not true. I don't have to buy it March 20. If I wanted to hedge it and reduce the margin even more so that maybe I can profit stack, then I'd have to do a 322. And right now, those the 400s are way overpriced. Like right now, the 410s are at 40 cents. That's insane. So I can't quite hedge just yet. We'll need to wait about a week and see what happens. I don't have spreads again. Robert, what do you mean you don't have spreads and can't trade a calendar? If your broker won't let you, you need to contact them and say, listen, this is ridiculous. I should be able to trade a spread, right? So just have them, if that's what you're talking about, just have them turn on the permissions. Let's see, TD is now owned by Schwab. Yep. So as long as they don't change the API access, with the Schwab and the TDA merger, that's fine. But that's a ways out, from what I understand. It was nice looking at one strategy. My head is not spinning as bad. X. So you did mean XSP, mini SPY. Ooh, I know nothing about that actually. I have not looked at that at all. Don't know anything about the options on that. Hang on one second. Let me see if it's on Tradier. And X. If that is the case, man, that would be a great learning tool. But you're going to be, the fees are at that point. Let's see, XP 391.19. Let's see if they've got options. I'm showing options. Gosh, I'm going to have to play around with that. That is a good question. Mike, have you done any trades in those? Any option trades? And any comparison on the fills between that and SPY? Gene, you're welcome. Can you comment on best ways to enhance crazy calendar trades once you're in them? If we go out 2-3 weeks, then there should be lots of opportunity for that. Jeffrey, so the enhancement issue, I know the industry talks about enhancement, but I don't like that being a given. Okay. Enhancements aren't necessarily the best thing in the world to rely on because they may not always be there. And so if there are enhancements, great, then take it. Sometimes that's adding a trade. Sometimes that might be taking off part of the trade, et cetera, et cetera. But bottom line is when you put on, especially one of these crazy calendars, you have to accept the risk of whatever that is. Period. End of story. You have to accept the risk. And that way, if you get to the point where the market, so a couple of times where the market has moved past the profit zone on official trades that we've taken, it's happened twice, and I just hold. And if the market moves back into the profit zone, gives me an opportunity to take a profit, I'll do that. Now there was an unofficial trade that I was in. Unofficial being it wasn't a trade that we put together on one of these calls. I placed it outside of this call for a different reason, but it was a crazy calendar, and the market shot up so far past the profit zone so fast that I could do nothing. I just had to hold. And then finally, the last day, the market did move down a bit back towards the profit zone, and I got out for a small loss. About $100, I think, is what it was. So you have to accept the risk. I have TOS and you negotiate lower commission. I'm at 50 cents a contract. Yeah, that's still pretty high. TRADE-REC, it's only 13 cents. Reminder, not possible to do diagonals on SPX. Yeah, you have to leg into those. And oh, by the way, they charge full margin. Even if you leg in, they charge full margin. I almost forgot about that. So they don't count your long leg. I don't care, even if it's after, they don't count it as a part of a spread. Thanks for that reminder, Bernard. The overlapping weeks positions is an issue for me, as I prefer to pay with the short call and margin hedge. Any suggestion with that scenario? Juan, so you should, if that's the way you're doing it, which obviously you have to have a bigger account to do that way and accept the bigger risk, but it's a higher probability. It's one of my favorite ways to do it. You just can't compound that quite as efficiently, right? So from a compounding standpoint, it's not as good. But when you're able to do that, you're able to go out further out of the money. So you usually can bring in a credit and go so far out that you don't have to worry about going 3 weeks out or even 2 weeks out necessarily. So 319 is a crazy week for crazy calendars. Well, it's not really crazy. It's just one level of complexity added to the situation. But the good thing about it is that we can get a credit, right? And so we can get a credit way further out of the money, and that gives us a little bit higher probability of not having to deal with the that. And by the way, we're out usually on Thursdays anyway. The real issue is the pricing difference with the calendars. That's the real issue. With the dividend on 319, how will that affect positions after that, such as 322, 326, etc.? If I were in those. So you have nothing to worry about. If you go even a further week out, you have nothing to worry about as long as they're still out of the money on ex-dividend week. If they're in the money on ex-dividend week, then it totally depends on how much extrinsic value exists in those calls. And that's going to determine whether they assign you or not. And if there's more extrinsic value than there's dividend that's being paid, they're not going to assign you because they wouldn't make any money doing that, right? But I've found myself in a situation where they have assigned me where they where there's like maybe 50 cents of extrinsic value, and I just turn around and I sell the thing again on Friday morning for another 50 cents. Um, it's a little bit more complicated than that because you're still going to pay the dividend. Once you're assigned, you pay the dividend, right? But you collect the entire value of that short option, and sometimes you can collect it again. I don't suggest doing that for most traders. XSP has very little open interest, so I figured it would. Let's see here. I have TD Ameritrade and I can trade level 3, but I'm linked to Trade Partner and trying to follow you from TP. I guess I'm not. Is that a question, Robert? I'm not quite understanding that. I've done some practice trades, works well, but has lower volume, which can be scary getting out of the trades. It seems to be growing in popularity, though. Something I'll keep an eye on. I just compared option prices, same expiration, same strikes from XP and WA and SPY, and it's within pennies of each other. I did notice that the volume is super low. Yep. Interactive Broker says XPS is Canadian Exchange in CAD. It doesn't have weeklies. Huh. Well, I'm looking at TRADE-REC, and I'm seeing Monday, Wednesday, Friday expirations in XPY or XSP, sorry. So not sure what the deal is. I'll open up my IB account here in a second and take a look at it. The 400 calls is Friday 37 volume on XP. So the 400 calls on the XSP is at 37 versus 95,000 in SPY. So there's obviously 30 volume is 37. Interesting. Okay. So you're looking at the stock XSP. Got it. So Robert, there's no issue with putting on spreads in TD Ameritrade on Trade Partner. Are you having an issue? Is that what you're asking? So you can do, you can do anything with Trade Partner with either broker, whether you're TRADE-REC or TD Ameritrade. So if you're having an issue with something, let me know, and obviously contact support. All right. A lot of questions. So we are obviously way over time, but that's all right. That's why we have these. So looks like I got everything. We'll talk about open positions on Friday, or excuse me, on Thursday. We won't be focused on a single strategy Thursday. We're going to kind of go through all over everything. That's the way I'm going to try and do it. And then next Monday, we will focus on the setting up risk-free calendars. That'll be next Monday's topic of the day. All right, guys. Hope you enjoyed the call. I will see you on Thursday. Robert, TP doesn't show the spread like you have. Can you send an email? Because yeah, I'm not quite sure what that means. So send an email to support and let them know that I asked you to do that and have them forward it to me. Or shoot or a screenshot. Get onto chat and shoot them a screenshot, and they'll forward it to me, and I'll see what you're talking about. All right. Everyone have a wonderful day. I'll see you on Thursday.